Welcome to Investors Guide. Thank you so much for tuning in. Grab a pen and paper because we have so much advice that's going to come your way over the next half hour. You're going to want to write it all down. We're going to start by taking a look at our growth portfolio that's continuing to do well in this choppy market. We'll also take a look at the HDFC Top 200 fund that so many of you have written to us about. And we'll tell you whether you can claim a tax exemption on the money that's transferred from your NRE account to your savings bank account. It's time for me to bring in Dhirendra Kumar, the CEO of Value Research. Dhirendra, thank you so much for joining us on the show. We've got a lot of fantastic responses to the new look of the show, but I think the fundamental policy of the show and the fundamental advice does not change, which is to use SIPs, to not put lump sum amounts into the market in any way, and of course to plan for the long term. We've, in fact, over the last 7 years since the show has been on air, started to get fewer and fewer questions from people asking us whether they should invest a lump sum of money or whether they should in some way take advantage of the market. Given the market that we're seeing right now, again, there is, of course, a learning that goes through it, but what is the one piece of advice you want to give all of our audience members about the current stock market?
Don't get distracted. If you have a plan, stick to it and ignore the noise. That is something which is very difficult to do when you are bombarded with so many things happening at the same time, and it is very difficult to persuade ourselves that okay, why it doesn't matter or why it matters, but it actually doesn't matter. My understanding is that for most investors the most important thing they should follow is keep saving, keep investing, and keep investing without getting distracted.
Of course, the biggest piece of information to take away from there is to ignore the noise. Now, through the week, you will hear a lot of noise about the stock market, a lot of which will be happening during the day. But you must remember that information is for day traders on any business channel that you hear. It is not for you and me as retail investors. So ignore all of that noise and don't let it affect your long-term portfolio. And of course, our portfolios that we've designed on this show, these model portfolios, are meant to illustrate just that. Let's take a look at our growth portfolio today. Now, this portfolio, and I'll give you a recap of the funds in it. There is the FT India Dynamic P ratio at 20%, iPRU Dynamic, Quantum Long-Term Equity, the Templeton India Equity Income, and the UTI Equity. Now, we've been investing, hypothetically, 10,000 rupees every month in this portfolio for 7 years. So far, that money is currently valued at 13.86 lakh rupees. When we look at this portfolio right now, and it's given us about 14%, as a return over the last 7 years. And I want to use this sort of as an example of what we're going through in our market right now. And we've seen the ups and downs. We saw the Brexit, the reaction to Raghuram Rajan's exit. And then after that, a week later, we saw a reaction to the Brexit announcement. And then now we're going into another earnings season. This is exactly the kind of information that, long-term investors should not react to. And this portfolio is an example of that. We've had no reactions. We've not made any knee-jerk reactions to any of the information that has come in over the last 7 years. And the portfolio has done well throughout that entire period.
Yes, very few changes made in this portfolio. And even the few changes made were primarily based on the funds not doing well or superior alternatives being there. And we have also resisted the temptation to make changes just because the fund is not doing well for a brief period of time. And that has actually paid off in this fund. Look at, Quantum Long-Term Savings Fund. There was a phase when we were saying that it was not proving to be a great fund. Still, now it has paid off. So, one has to be through a full market cycle to reap the benefit of such a strategy. The other important part of this portfolio, which we should feel proud of, is these are the good times. But even in the worst of times, this portfolio did not go under, water. So that's very important. It's very important for an individual investor to be continuously, reinforce that feeling that your money is doing fine. And there is a psychological barrier against deep losses in your portfolio, even on an ongoing basis, and that is something which we should be aware of.
But Dhirendra, I want to come back to that point you said about the Quantum Long-Term Equity Fund, where at some point it was not performing like we expected, but we held on to it, and now it has turned around. So, as an example, for anybody watching at home right now who has a fund in their portfolio, they're sort of worried about What is the time period we should give a fund ideally? If it starts to slip, is it 6 months, is it a year, is it 2 years? What would you recommend?
Generally speaking, it is year and a half, but it also is a function of if you understand the reason why it is not performing, and you buy into that okay, it is not performing for this reason, but exactly for this reason it will perform again. And that was very well communicated by Quantum. That was very well communicated by some of the other relative underperformers in recent times. So I would say understanding the reason is very important.
We're moving on now to our special segment on your financial plan. Dhirendra, our profile today is a 30-year-old who's supporting a wife and his retired father. His goals are to retire in 30 years from now. Shrikar has written in from Chennai. He tells us he wants a corpus of 15 lakh rupees for a down payment on a house in the next few years. He also wants to save about 1.5 crore rupees for his child's education and wedding, and 5 crore rupees for his own retirement in 3 years. The brilliant part about this portfolio is that he's got his term insurance taken care of, he's got health insurance for himself, and he's got a family floater insurance for his wife, and his father is covered by his employer's insurance, for which he pays a premium out of his salary. He has 2 lakh rupees in bank deposits, which he's using as an emergency fund. He has the EPF, and he's also planning to start investing in the NPS to avail of the tax benefits. Now, he has about 12,000 rupees a month going into mutual funds. But before we go into the funds that he's invested in, I mean, I'm really pleased at the way he's organized his portfolio. He seems to have checked all of those boxes that he needs to before he starts investing. And at 30 years, he has plenty of time to invest for his retirement and for his child's future. His child is not born yet. So 2 thumbs up then for him and his organization and his portfolio.
No, all his variables are very nicely in place. The essentials to be done before you start investing is all taken care of. The other thing which comes to my mind is forget the NPS. The kind of goals for which you are investing, your retirement is many, many years away, few decades away. That part, your long-term goals of child education, and the home will be taken care of in the next 5 years. So there are 2 ways of looking at NPS. Work towards saving that extra 80 CCD benefit that you'll get on your investment in NPS, or investing the full amount in a normal equity fund. Deposit your 15,000 rupee tax which you would have otherwise saved, and then let that money accumulate in an equity fund. The only reason why one should invest in NPS are the indisciplined ones, who will not be able to resist their temptation to pull their money long-term savings for some consumption. But I don't think for somebody like him who is disciplined, who has organized his finances and is working towards goal and is very clear about his goals, I don't think that is that much of a concern.
All right, so the ELSS is a better idea. He's also picked a couple of funds, Dhirendra. We'll run through his list. He has the iProof Focus Blue Chip, the HDFC Mid-Cap Opportunities, the Axis Long-Term Equity. These are funds he's already investing in. He wants to add the Franklin India Tax Shield and the Franklin India High Growth Companies. Now, if he uses this portfolio, then can he sort of disregard the NPS and just go with the list that he has right now?
He has chosen good funds, so he can carry on with this, and or he can go for our aggressive portfolio, which will meet most of his needs. The only money which should go into a balanced fund is, a part of his money, maybe a fifth of his savings, fifth or, 25% of his savings should be accumulated in a balanced fund towards the home, his down payment for the home in next 5 years.
All right, Dhirendra, would you recommend a balanced fund for him to put his money in?
Yes, I would like to recommend, 2 of the 4 balanced fund in our stable growth portfolio. I'll recommend him the relatively aggressive ones, the Canara Robeco Balanced or Reliance Balanced.
The Canara Robeco Balanced and Reliance Balanced are on your screen right now. The rest of your portfolio seems fine. Good luck with that. And if you need any more help, you can get back to us. Remember, Dhirendra has a couple of takeaways for you on your portfolio. The first of which is relook at your long-term goals. It's likely your target will need to be a lot higher than what it is right now. We like the way you've organized all of your insurance needs. Rethink your NPS requirement. It's sort of designed for someone who's not disciplined enough, but if you can be disciplined about your mutual funds, you will be on track. Before we go into break, key takeaways of what we learned in this segment. First of all, ignore all of the short-term noise you hear in the newspapers or on TV channels about what's going on in the market. Stay focused on your long-term goals. Invest for the long term. Dhirendra, they're saying that if you have a medium-term goal in the next 4 or 5 years, it's safest to use a balanced fund instead of a complete equity fund. And of course, choose funds that offer stability and consistency over the long term. Don't go for something that you think is going to give you some sort of quick overnight returns. We're going to take a quick break, but when we come back, we'll stay with our theme of keeping faith in our funds, HDFC Top 200. So many of you have written to us asking us what you should be doing with that fund. Advice on the other side. Don't go anywhere. Welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us. This week we look at HDFC Top 200. Now, this is a fund that has been on our radar from the time we launched the show 7 years ago. It's had some excellent phases and it's had some very difficult phases as well. Avan will give us a recap on how the fund has done over the last couple of years. Avan.
Thanks, Faith. This week we take a look at the HDFC Top 200. With over 13,000 crores as assets under management, the fund has had good returns over the long term. Its performance, however, has been slipping in the last couple of months. Let's take a closer look at the performance chart over the last 5 years. The red line is the fund and the blue line is the benchmark. You'll see that till the year 2012, the fund has done marginally better than its category and benchmark. You'll also notice that in the year 2013, the fund gave a return of barely 4%, much lower than its benchmark and category, thereby slipping in its ranking to 3 stars on Value Research. Although the fund's performance was much better with the next year, with a return of almost 47%, it slipped yet again in the performance chart in the year 2015 with a return of -6%. While the fund's 10-year returns have been much better than its benchmark and the category, the fund's peers have had better returns over the short term. So is this a fund that you should hold in your portfolio? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for that information. Today, the HDFC Top 200 is dropped to 3 stars on Value Research right now. And we have a lot of very worried investors who are wondering if they should hold on to this fund. Now, I'm going to go back to what you said in the previous segment of giving a fund a year and a half or maybe 2 years to see if it recovers from a bad phase. Would you recommend giving this fund more time?
Oh, this fund has recovered very smartly in recent weeks and months. And looks like the manager's hypothesis of, focused on a segment of the market which was relatively lackluster or keeping relative, what worked in the last 2.5 years, that the fund managers was relatively underweight on that. And so there are very clearly attributable reasons why this fund did not do well and why it is doing well now. And if economic recovery and the change in the complexion of the market, what is driving the market, that changes or progresses, this fund will benefit. Also, the other advantage of this fund is that this fund is managed by the same manager with a 20-year history and has done exceedingly well and has also done very poorly in a different kind of market. My only worry is that this fund has turned big, its character has changed. Through most of its life, it has been a multi-cap fund, and now it is committed to being a large cap fund. That is how it will do well. Its big bets has to work, and so this fund, the character has undergone a change, and it will remain like that. So from that standpoint, investors' experience will be very different from what it has been in the past. So one important thing, one important message of all this underperformance is that I have come across situations, I have come across investors who invested in different funds, assuming that they are getting different exposure and different diversification. In this program itself, we have got so many questions where investors invested in HDFC Top 200, HDFC Equity and HDFC Tax Saver and HDFC Prudence, and sometimes all of them together or a combination of some. And they thought that they are diversified. Those investors need to really take a look that what is where their money invested differently, where they're getting real diversification by owning different funds. And that is, I think, very important. This fund will make a comeback. It is beginning to make one. Right now it looks very impressive. But last year was, for last 2-3 years, it has been a bottom quartile fund in its category. But more importantly, the character changing really concerns me, and I think that's the reason why. And investors have plenty to choose from. There are, good options for investor to among the multi caps, and they also get you wider diversification or exposure to the market. And that's the way to go for even most conservative investor than going with a large cap fund, which is forced to be a large cap than by its design.
Well, Dhirendra, finally, what is your rating, star rating for the viewers of Investors Guide on the HDFC Top 200 fund? And would you recommend people go out and invest in this fund right now if they're making a fresh investment?
No, I would not recommend fresh investment. And at the same time, going by its risk-adjusted performance, and till the performance sustains, and I would like to see it really making a comeback in a more durable way and stating how it is going to conduct itself over time. I would say it remains a 3-star.
All right, 3 stars there for the HDFC Top 200 fund on Investors Guide. Here's our new segment now. It's called Buy a Home, where the idea is to help you with the investments that you need to make so that you're able to buy a home. Gopinath has written in, Dhirendra. He's been investing in equity for the last 4 years. He invested about 11 lakh rupees and currently it's valued at 16.5 lakh rupees. Here's his question. He wants to buy an apartment worth 36 lakh rupees. He wants to know his first choice is to pull all of the money out of his equity investments, add a loan to it for the rest of the money for the difference, and buy the house. The second option is to continue investing in equity for the next 15 years and buy the apartment after that so he doesn't have to take a loan. He's currently paying rent of 10,000 rupees per month and he has an income of 60,000 rupees per month. What would you recommend he does, Dhirendra?
I would recommend him to, base his decision based on his requirement. If he is able to buy the home and save that 10,000 rupee and even spend 5,000 rupee more on the EMI, he should, and subject to he starts living in that home in foreseeable future, in 1.5 years time. If he starts living in that home, that will be a worthwhile thing. If that is not the case, he should accumulate his savings. There are great advantages of doing that because he will be at liberty to choose the home when he wants to buy. The house will not be depreciating. He'll not have to worry about putting it on rent and have vacancy in between. And so in the end, I think the money will be liquid enough and he will have enough resources to buy his home anytime he wants to.
But Dhirendra, I think the real question he's asking here is, over the next 15 years, what are your expectations of return from the equity market or from an equity mutual fund at least?
I'm hopeful that equity markets will deliver more than fixed income and more than inflation. And it is and if we are going by what has happened to inflation and the way the fixed income is likely to behave, likely to be in coming years, equity return is unlikely to be what we have seen in the last 15-20 years. But we will still be better off even with lower returns. If fixed income return comes down to 6%, I'll be very happy with a 12-15% long-term return on equity. It has been 20% on the Sensex over the last 20-25 years, which is very impressive. Look at actively managed fund, it is even more.
All right, so Gopinath, here's the advice you're getting. Of course, if you can buy a home that's ready to occupy, and that's really what we recommend, instead of buying something that's under construction, it comes with a fair amount of risk on delays. Look at something that's ready to occupy. And if you do that, then you're looking at an EMI of about 20,000 rupees. So, and you can save the 10,000 rupees that you're paying on rent. That's an added, outgo of 10,000 rupees every month. So make sure that within your family's budget and the money that you're spending every month, you're able to take that extra hit of 10,000 rupees from that budget. Dhirendra is saying that if you want to, if this is not a home that you're going to live in, that you're maybe going to rent out, then it makes far more sense to invest in equity because the returns you'll get out of equity will be far higher than any rental return across the country right now. So here are your choices. If you're actually looking for your first home that you're going to live in, look for something that's ready to occupy and then consider going in for it. But if it's an investment, equity makes more sense. All right, so before we take a break, the key takeaways that we learned in this segment of the show is to have faith in the funds you invest in. So remember, you have to have a reason. Write it down. This is the reason why you're investing in this fund. And you keep checking back to make sure if that reason still stands. So even if the fund is going through a 6-month or a 1-year bad phase, if the reason still stands, you hold on to that fund. And Dhirendra is saying give it, about 12 months before you decide whether or not you want to pull that money out. Diversify your portfolio, but only with a maximum of 4 to 5 funds. Dhirendra, thank you so much for joining us on the show this week. We're going to take a quick break right now. We'll come back and answer your tax questions on the other side. Don't go anywhere. Welcome back. You're watching Investors Guide. Thank you so much for staying with us. Suresh Surana of RSM Astute Consulting is here to answer our tax-related questions. Praveen Mahajan has written in. He says he purchased a flat in February 2016 and he paid the stamp duty for the same. However, he's still not gotten possession of his flat. He wants to know which financial year he should make that claim of stamp duty. Is it 2015-16 or 16-17? Suresh?
Yes, so Mr. Mahajan, as far as the payment of stamp duty for purchase of residential house is concerned, it is eligible for deduction under Section 80C in the year of payment. So you will be able to claim it in the financial year 15-16 itself. Of course, this is the subject to the overall limit under Section 80C of rupees 1.5 lakhs. But within that limit, you can definitely claim it in financial year 15-16 itself.
Dev Rajan has also written in. He wants to know whether he can claim tax exemption on the money that he's transferred from his NRE salary account that he opened overseas to a savings account in India. Both accounts, he says, are in his name. I don't know if there is a tax exemption for that transfer at all, Suresh. What would you recommend he does?
Yes, so Mr. Devarajan, if I understand what you are saying, that if you have transferred the money from your account outside India to your NRE or NRO account in India, that is not a receipt of income in India and it will not be subject to tax because it is simply transferred from your account to your account in India. You must take care to ensure that you do not directly receive any income into the Indian bank account, either in NRE account or NRO account, because if you do that, then that income may be subject to tax in India. The other thing is that whatever you are having the interest on the NRO account under Section 80 TTA, you can claim a deduction up to rupees 10,000 on the interest income on the bank saving account. But you have to take care not to remit any income directly into the Indian bank accounts, NRE or NRO accounts.
Kanan has written in from Bangalore. He deposited a little over 12,000 rupees as his self-assessment tax for 14-15. He verified the tax credit. He says it shows as assessment year 2013 and 14. That's an error, obviously. How can he get that error rectified? Suresh?
Yeah, so it appears that when you paid the tax, you might have paid it for assessment year 13-14 and therefore it is reflected in Form 26AS as the assessment year 13-14. You need to log into your e-filing and there is an online sort of request for rectification you can do by giving all the relevant details, and thereafter then they would carry out the necessary changes and also give you online credit accordingly.
All right, Suresh, thank you so much for answering those questions. Remember, on Investors Guide, you can write in to us about anything to do with your money. That's what we're here to help you with. And you can reach me personally on Twitter. Thank you so much for watching.